In previous session, we understood the concept and overview of weighted average cost of capital. We learned why do we calculate it and how do we use it. What we need to do now is how to calculate it. So cost of capital, we know that capital consists of equity and it includes debt. And of course, we need to calculate cost of equity, cost of debt, and then the average of weighted average cost of equity and the debt. So it says that we have covered how to work out the cost of various types of capital, equity, and debt. Yes, we have done. We know that there is a redeemable debt, there is irredeemable debt. We covered the cost of preference shares, cost of loan, cost of convertibles. We did all of them. Then we also calculated cost of equity through dividend growth model, probably with, CAPM model and so on. Now, most businesses have a mix of capital. That is true. Yeah, there are some businesses which are all equity financed, which means that they do not have debt. But most businesses, they have a combination of equity and debt. And then within debt, they have multiple types of debt. They have different types of debt. For example, a business might have, 20 million bonds in issue, 10 million of bank loan, 5 million of preference shares, and so on. And of course, probably 30 million of equity. So cash goes into a pool, and investment projects must be able to pay the suppliers for the overall pool of finance. Overall pool of finance means that you are bringing in cash, which is capital, from different sources, and every one of this source has its own cost. But you finance a project, you don't exactly determine that where the cash is coming in. It actually is the average of the cost. So I might be having debt at 7%, debt at 9%, debt at 5%, equity at 12%, and so on. So I find out that in my overall pool of finance, which is $100 million, it includes 60 million of equity at 12%, and then 20 million in debt, in bonds, maybe 8%, another 20 million in bank loan at 7%, maybe 5 million of convertibles at 6%, and so on. So we need to calculate the average of that. So this is your capital, and it has multiple sources of financing coming in, and each one of this source has got its own cost. And we have actually calculated, we have already learned how to calculate the cost of equity, cost of debt, and then different types of debt, preference shares, convertibles, etc. We already have covered that. So this session is actually going to conclude all of that information put together. Okay, so what we need, the overall cost of finance is known as the weighted average cost of capital, which means the average of all that multiple sources of finance coming into that your pool of finance. What is the average cost? And WACC is the cost of each element of finance weighted by the proportion of the market value, weighted by the proportion of the market value. Okay, weighted by the proportion of the at the so what you need to do, for example, when you say that your total capital is 100 million, so out of 100 million, how much is equity? Let's suppose equity is 60 million, so the proportion is 60 over 100. 100 is the total capital, equity plus debt. 60 is only equity. So this is what we say, that this is the proportion of equity. And then how do you calculate this 60 million? You calculate it at the market value, not at the balance sheet value. So this is probably the market price of shares multiplied by the number of shares as compared to the total market value of the cost pool. So when I said this 100, this is the total capital, equity plus debt, but not the book value, the market values. Okay, so what you need to pay attention here is that we will be using the market values, because the face value of debt, the par value of the debt could be different, the face value of the share could be different. We always think about the market values. WACC is usually the rate that is used to work out the NPV. Yes, when we were in the previous session, when we discussed the introduction to WACC, weighted average cost of capital, we said that WACC is the discount rate, which we use to discount all of the cash flows in an entity for multiple purposes, whether you are calculating NPV or you are doing for some other purposes. So the discount rate which we use for the sake of or for the purpose of discounting is actually the WACC. And this is the formula. Okay, so it's very simple formula. It might look difficult, but Trust me, this is the easiest of all. So this is the market value of equity, between market value of equity divided by value of equity plus value of debt. So this is the total capital. So what you are doing, equity over capital. So if I can rewrite it, I can say it equity over the total capital, or I can say equity over equity plus debt. And because you are taking here equity, you multiply it with the cost of equity. Cost of equity, which we have calculated using CAPM maybe. And then you say plus value of debt. So this is actually debt over equity plus debt. Equity plus debt, and you multiply it with the cost of debt. Which is this cost of debt? Which you have calculated probably as redeemable debt, irredeemable debt, preference share, whatever it is. So cost of debt, and then you multiply this thing into 1 minus t, because we know that debt has your tax savings, that brings you tax savings, it gives you tax benefit. So you always take post tax cost of debt. We discussed it several times that whenever we talk about cost of debt, you always need to take post tax. And how do you do post tax? Multiply it with 1 minus t. So if tax rate is 30%, this should be 0.7. Okay, so this is the basic formula. um, Not really very difficult. Now, let's see how do we put it into action. We'll take one question, okay? So a company has the following capital structure. Equity, 1 million shares valued at 2.3 each. So face value of the share might be $1, but the market value is 2.30. And the cost of equity, which is KE, is 18%. So I can say that value of equity here is 1 million shares at 2.3 million. So 2.3 million is going to be your value of equity, and this is going to be your cost of equity. Then it says debt. Now, debt has different types. So you have 0.5 million debt. These are 6% debentures. So bonds, which are 6%. The market value is $90 percent. The face value could have been 100, and I'm sure it was 100. But we will always consider the market value. Post-tax cost of debt is 6%. So for these bonds, post-tax, not pre-tax, post-tax is KD is 6%. The market value is $90 and 0.5 million. So we have to multiply 0.5 million. 0.5 million means half a million. Okay. So half a million was the face value. But in the market, it is currently sold at $90, which means it is currently sold at 90% of its value, because face value is usually 100. So if it is in the market sold for 90, so it is at 90%. So I have to multiply 500,000 with 0.9. So I say that the market value of this debt is actually 450,000. So I need to consider the market value of the debt 450,000. Then you might have another form of debt in your pool, which is called preference share, which is again half a million at 0.50 and 10% share. 10% is the coupon rate which you are giving. 10% shares valued at 0.40 each. Cost of preference capital is 12.5%. Your cost of preference capital is 12.5%, and it is sold at $0.40. Okay. Face value was 0.5, but it is sold at 0.4. So you should be considering the market value. Then is there anything left? What is the WACC? What is the weighted average cost of capital for this particular entity, which have these elements in its capital structure? So we'll pick up the market. We'll make a short table. This is the same data I'm repeating again. So don't need to read again. We just have to put it like this. I've got 1 million shares sold at 2.3. So 2.3 million is the market value of equity. Debenture 0.5 million at 90%, 0.45 when I was saying 450,000. Here it is shown in millions. Okay. So when I said I calculated above $450,000 in previous screen, that is actually this one, 0.45. And then you have preference shares, half a million preference shares. Each share is valued in the market at zero point 0.4. So half a million was the number of shares. And this is actually debenture 0.5 million. And this was actually the value in dollars. And this is actually the value in numbers. So now you come down to 0.5 million with the value of, how to say, it's the value of preference share at 40 cents. So you come to 0.20. So your total market value of capital is 2.95. Now, if you talk about how do you calculate proportions, proportion will be 2.30 of equity divided by 2.95. Debenture is actually 0.45 from a total capital of 2.95. And my preference shares are 0.20 divided by the total of 2.95. And then I need to multiply them with the cost of equity, which is 18%. And this cost of debenture was 6%. This I have to multiply it with 6%. And this preference capital is into 12.5%. And then I will find out my average. Okay. So let's see how do we put it here. If we have here, yeah, this is how we did it. So 2.3 divided by 2.95 into 18% plus 0.45 divided by 2.95 into 6%, which is this one. And the last one is this one, 0.2 or 2.95 into 12.5. Your weighted average cost of capital, WACC, is 15.8%. What is 15.8%? It is the average cost of capital. This is the average return which you have to pay to the providers of finance, whether equity or debt, in order to retain their interest, in order to keep their capital, in order to use the funds. Okay. And when you will do NPV or IRR or any other discounting thing, you will discount your cash flows with 15.8%. So this was a rather simple example. I want to do one more question with you, which will have the same calculation for WACC, but before WACC, it requires some additional working. So let's see one more question here. Comprehensive example. A company has the following capital structure: equity 2 million shares valued at $3.30. 2 million shares into 3.3, I can say that market value of equity is 6.6 million. Current dividend of 0.06 about to be paid. Dividends for each last year have been this much. Now, what is important to see here, that in this question, we are going to calculate the WACC. To calculate WACC, we need cost of equity. Okay. And cost of equity is not given here. If you pay attention, it does give you the market value of equity, but the question does not provide you with how much is the cost of equity. You have debt, 500,000, 8%, valued at 112. Premium, it is redeemable at premium of 20%, and corporation tax is 30%. Okay. And by the way, you don't have the cost of debt as well. This is your coupon rate, and this is a redeemable debt. So I need to calculate IRR of this debt. And when I use calculate IRR, that will be my cost of debt here. In this case, I need to calculate my cost of equity. And cost of equity has two formulas. Either you use CAPM, capital asset pricing model, but for CAPM, you need to have RF and RM, risk-free rate and market return, which are not given here. So then how do I calculate KE? So you have two methods. Either you use CAPM, but the data which is needed by CAPM is not given. Therefore, I have to use my dividend model. And because they are giving us 2 years data, so I can use dividend growth model. And I will calculate the growth, and then I will find out dividend growth. I will apply dividend growth model. I will calculate KE. Then I will come up here and I will find out the KD for this thing. And once I do KE and KD, then I will say, okay, value of equity over value of equity plus value of debt. Value of equity and value of debt is given, but this KE was not given. Similarly, then I will say value of debt over value of equity plus value of debt into cost of debt, which is not given. I will calculate from here into 1 minus t. So this example question will take slightly more time, because ultimately the formula for WACC will remain same. But you need to use KE and KD in that formula, and that KE and KD is not given. Okay. So let's see what is KEKD. This is the formula which we use for, okay, this is scary. Forget about this, okay? This image is scary. Let's focus on here. How do you use cost of equity? You need to use cost of equity in your dividend growth model. This one. We have done that thing before. In dividend growth model, you need to use growth. How do you calculate growth? You calculate growth with that formula that G is equal to, if you remember, 0.45, which was, there were two dividends which were given to you. So you had an initial dividend and the later dividend over 2 years. Okay. So 2 years dividend was given to you. So that was 0.415. So what happened, that how to calculate growth on the dividends? This is, you had the dividend earliest. This was the previous dividend. This is the then second dividend. And now you are planning to give 0.06 dividend. So you are increasing your dividend from 0.04 to 0.05 to 0.06. So dividends are growing. So how much growth you have done? We use the same formula. If you remember, I told you that we said that the future value or the final value is equal to the present value into 1 plus I is the interest. Here I say 1 plus G power N. Okay. And then in this case, the future value, the latest value should be this one. This is the latest value because it has been announced. So you would say that 0.06 is equal to what was the initial value? 0.415 into 1 plus G power N. N was 2 years, not 3 years, okay? Because it was 0.04, 0.05, 0.06. The data is for 3 years, but there are 2 years. We have explained this thing. Why? Because from this year to this year, this is 1 year. From this to this is 2 years, okay? So you have to put power 2 and then you solve it for G. Then you have to take out G outside and calculate the G. We have done this thing in detail with question practice and with lectures as well. So this is what we have done. And we find out that ultimately the growth itself is actually 0.2, which is 20%. I put the same numbers in this equation, okay? Solve the same equation. It's nothing different, okay? So 20% is growth. Now, when you have 20% growth, you say, what is your, because if you remember that here when we use P naught is always used as X dividend market price of the share. So what is the current market price of the share? 3.3. And they said that the company has announced the dividend. So this is the current dividend. You subtract it. So this is like the X dividend market price of the share. So I've got X dividend market price of the share as 3.24. I've got 20% growth and I put it into the same formula. K is equal to D naught. D naught is the last dividend, which is 0.06 plus 1.2, which is growth, divided by P naught, which is 3.24 plus G. And you find out your cost of equity as 22.2%. So when you will go to WACC, you will say value of equity divided by value of equity plus value of debt multiplied by cost of equity. This will be multiplied here. 22.2%. Okay. So we wanted to find this one. So first number we have calculated, which is cost of equity. The second number we need to calculate is the cost of debt. And if you remember that because it is a debt which has to be retired in 4 years, so that was a redeemable debt. And in our previous explanation, we told that the redeemable debt, if the debt is redeemable, the cost of debt is actually equal to IRR. So we will calculate IRR for the cash flows. So what is the market value of the debt? If you remember, we solved it. We always start with in time zero you put as a negative cash flow or cash outflow, which is the market value of the debt, 112, it is 8%. It was 8%. Let me show you if you might have forgotten that if the debt is 8% or not. Yeah, this is if you see that the market value of the debt was 112 and it is 8%. 8% on $100 because the face value is always 100. So it is 8% of 100 is $8. Tax rate is 30%. So we take after tax cash flows. So this is initial outflow 112. Then from year 1 to 4, because it is a 4 years thing, it is $8 into 70%. 70% means 1 minus T, 1 minus tax. Tax was 30%. So this is your cash outflow in year 1, year 2, year 3, year 4, and we took a 4-year factor at 10%. 10% we chose ourselves. That is not an issue. You can choose 12%, you can choose any percentage. So we chose 10%. And then we have in the last year, fourth year, this $100 debt was supposed to be redeemed at 20% premium. So you have to pay $120. So that is the final amount with premium. And this is the 6th year present value factor. This is 4 years annuity factor. 3.16 is what? You will go to your annuity table. You will see 4 years at 8%, at 10%, 4 years at 10%. So this is the annuity factor, but this is the 4th year present value factor, which is 0.683. You calculated the discounted value, it is negative. Now you remember that to calculate IRR, you need two NPVs. One has to be negative, one has to be positive. You've got a negative NPV already, and now you need a positive NPV. So if you want to increase NPV, you decrease the discount rate. So you calculated here 10%. If you calculate 12%, it will become even a bigger negative. If you calculate 15%, even a bigger negative. So I want a positive number. So I decrease the discount rate. I say, let's do it with 5%. So these are the factors. One is always the factor for time zero. And this is the annuity factor for 4 years at 5%. This is the present value factor for the 4th year at 5%. And I multiply this thing with the same numbers, this numbers. Okay, so you get now these discounted cash flows and your NPV comes out to be positive. Now you have got the same IRR formula which we have done before. That IRR formula will be I've done it so many times, but I'm doing it again. I don't know. Please excuse me, because I still have doubt that sometime people they need every time. So I do it every time. This was your formula where A was the small discount rate, which is this one. And capital A is the NPV at the small discount rate. B, small b, is the higher or the larger discount rate. And capital B is the NPV at the higher discount rate. So you will start with A, which is 5%. You will say 5% plus A. How much is A? A is 6.62 divided by A minus B. So when you say A minus B, B itself is minus. It is itself is minus. So it is minus into minus plus always. So it will be 6.62 plus 12.29. Then you say multiplied by 10% because B percent means B is the bigger discount rate, 10 minus 5%. So when you will solve it for yourself, which you have done it several times before as well, you come to the answer, which is 6.75. So for that redeemable debt, I've got my KD as 6.75. Once you have calculated KE and KD, then life is like heaven for you because nothing is left. So cost of equity 22.25, cost of debt 6.75, market value of equity 2 million shares, each share at 3.24. This is my market value of equity. Market value of debt, 500,000, but they are sold at $112, which means they are sold above the market, above 100. So actually the market value of debt will be 0.56 because the bonds were sold for 112. $100 bond is sold at 112, so it is 12% more. So total market value of equity and debt is 7.04. Total market value of this plus this, equity and debt. Now you say, okay, value of equity is 6.48 divided by value of equity plus value of debt, which means these two. Sum total, they already have told us. No, these two. Market value of equity and the market value of debt. The sum total of these two is 7.04. So this is equity over equity plus debt. 7.04 is equity plus debt. I put as one number, okay? You multiply it with cost of equity, which is 22.2%, plus value of debt. Value of debt is 0.56. Value of equity plus value of debt, both of them is 7.04, multiplied by the cost of debt, which is 6.75%, okay? You solve it. This is what they have done here. And the answer is 21%. Answer is 21%. Now, this is WACC is so important that if you are doing financial management or you do advanced financial management or you do any type of financial management in any qualification or in any part of the world or in any company, the same method is used and the same method is used very frequently. This is not something which you will face on and off or which you will face rarely. WACC or the calculation of WACC is something which you will face very frequently. So you should make sure that you understand this chapter or this topic 100%. Not even a compromise of 1%. So don't settle down with 99% because this is one of the most important area, because the WACC you will use for discounting. So whether you are doing investment appraisal, you need to discount. Whether you are doing business valuation, you need to discount. Whether you are doing mergers, you need to discount. So discounting is important. Even when you do financial reporting, not even financial management, in financial reporting, you need to do discounting. So this is not something which you can avoid. Okay. So make sure that you understand it fully, you understand it 100%.